In this chapter, we will talk about the two main categories of liabilities, and that would be current liabilities and long-term liabilities, which include bonds payable and long-term notes payable. As for current liabilities, they include payroll and salaries and wages payable. They would include sales tax payable and short-term notes payable as well. So those are the two main categories of liabilities. We on the balance sheet, the company would include those under those two parts of liabilities. They would include current liabilities first, and then long-term liabilities. As we mentioned before, current liabilities would also include unearned revenues. They include payroll and payroll taxes. They include tax payable, sales taxes payable. They also include the current maturities of long-term debts. So those are long-term liabilities that are maturing this year during the current year. So as a result, there would be basically within 1 year of the financial statement, or within one operating cycle, whichever is longer. On the other hand, long-term liabilities, they would include bonds, they would include and long-term notes payable. And in this chapter later on, we'll cover both how to deal with bonds, how to account for bonds, as well as long-term notes payable. To start with, current liabilities are debts that the company would have to pay either within 1 year from the date of the statement, or within one operating cycle, whichever is longer. Generally speaking, most companies will have an operating cycle that is shorter than 1 year. So as far as we are concerned, unless otherwise stated, we'll always consider the current liabilities are the liabilities that are due within 1 year, unless otherwise stated. And there is another characteristic of current liabilities, and that is they are expected to be paid by either existing current assets or through the creation of another current liability. Basically, for example, converting an accounts payable to a note payable. So in order for current liability to be classified as current, the debt must have the following must be expected to be paid out of existing current assets by creating other current liabilities within 2 years, or A and B. The answer is, of course, D, which includes A and B, because they have to be paid. They could be paid out of existing current assets, or by creating current liabilities, and they have to be paid within 1 year and not within 2 years. The first type that we will talk about today is notes payable. Now, the difference between notes payable and notes payable are basically, this is the other side of the story. This is the other side of notes receivable. So the company A's notes receivable will be company B's notes payable. And this is, like we mentioned in the previous chapter, notes payable are this is where the company would sign an official, a formal, basically, promise to pay a certain amount. This has a formal proof of obligation. So it has this formal proof of obligation, and usually it also the person who is borrowing the money, person who is signing this note, promises to pay at maturity. They promise to pay the face value, that's the original borrowed amount, in addition to interest. So as a result, notes payable would incur or would lead to interest. This is basically when the company in plain English, saying that this is basically when the company borrows money and signs a note that they will promise to pay the same amount within a specific on a certain date or after a certain period of time, and during that time they will have to pay some interest. There are usually companies would issue notes payable in order to raise money, in order to find some short-term financing if they need to, for example, raise cash quickly, and they are usually issued for different periods of time. So for example, it could be 4 months, it could be 6 months, etc. If it is longer than 1 year, then it is not considered as current liability. At that point it becomes long-term liability. So for example, First National Bank agrees to lend $100,000 on September 1st, 2014 if Cole Williams Company signs $100,000 12% 4-month note maturing on January 1st. So in this case, the company who is borrowing the money is Cole Williams. So Cole Williams are borrowing the money. Cole Williams are borrowing the money, and they will be this for 4 months, and the interest that will be generated will be for 12%. Here the company is receiving $100,000 in cash from the bank, so the company will debit. This is preparing the entry for Cole Williams, not for the bank, for Cole Williams Company. So the company will receive cash 100,000, so it will debit cash 100,000, and it will credit notes payable 100,000. This is to record the issuance. This is to record the signing of this notes payable. This is when the company actually borrowed the money. Now, on December 31st, the company will not pay on that day. It is very important to note that notes payable, short-term note, current, when they are short-term notes payable, they are paid the full amount, basically, which consists of the face value plus interest. So face value plus interest are paid on January 1st. When we say maturing on January 1st, it means the face value plus interest will be paid on that day. As a result, at the end of December, the company will have to make an adjusting entry to recognize the interest that has accrued. In this case, the company we need to calculate the interest that has accrued. And how do we calculate interest? Interest is always the face value. So the interest, we always calculate it by multiplying face value multiplied by the interest rate multiplied by the time in years. So here it is 100,000 multiplied by 12% multiplied by 4/12, because it was signed September 1st, so it is September, October, November, and December, and as a result, interest will be 4,000. However, the company will not pay that amount on that day. We know now that interest expense will be 4,000, so the company will debit interest expense 4,000, but because the company will not pay it on December 31st, this is before maturity, which was on January 1st, As a result, the company will not pay it on that day. It will make an adjusting entry and it will debit interest expense and will credit interest payable 4,000. This is through the creation of basically through the creation of a current liability. Now on January 1st, this is when the company actually will have to pay the full amount. So January 1st, this is maturity date. The company will have to pay the face value plus interest. In this case, the company will pay 100. So we know that the cash paid will be equal to 100,000. This is the face value plus 4,000. This is the interest. But the company will be paying this amount to settle a debt. So the company will debit notes payable 100,000 and will settle also the interest payable debt of 4,000. At the same time, it will credit cash 104,000. That the company will not debit interest expense because the interest expense has been recognized at the end of December. So it was on December 31st, the company recognized interest expense. Here it became a liability. So the company will be paying those two liabilities. Notes payable are always recorded at face value. Interest payable is because the company did not pay the interest expense at that time. Hana company borrows 82,600 on July 1st from the bank by signing a 82,600 10% 1-year note payable. We need to prepare the journal entry to record the proceeds of the note. So when the company on July 1st, this is the day when the company signed the note. On that day, the company received cash because they borrowed cash, so they received 82,600 in cash. As a result, the company will debit cash 82,600. In return, they signed a note payable of 82,600, so the company will credit notes payable 82,600. We need to also prepare the journal entry to record the accrued interest at December 31st because it will not be paid on at the end of the year. So assuming that adjusting entries are made only at the end of the year. Here, we need to calculate the interest. The interest amount in this case is calculated once again as face value multiplied by the interest rate multiplied by the number of months by the time in year, which is 6/12. As a result, the amount here will be equal to 4,130. This is the interest expense. So the company will debit interest expense 4,130 and will credit interest payable 4,130. As you can see here, when you are recording the signing of a note, the company will debit cash, credit notes payable for the face value. And when the company is creating an adjusting entry at the end of the year, we will debit interest expense and credit interest payable, the amount, unless it was paid on December 31st. But if it is paid after December 31st, the company will debit interest expense, will credit interest payable, the interest amount. An interest amount is always calculated by multiplying the face value by the interest rate and by the number of months divided by 12. Another type of current liabilities is sales tax payable. Those are the taxes that the company will collect when, for example, when we go to Walmart or Target. We will be paying in addition to the price of a certain product. The clerk or like the employee at Walmart will also ring up the sales tax. So they will add also the sales tax, which will be collected by the company. However, it will be sent later on to the tax agencies. So at this point, the company will be just collecting the sales taxes. they don't recognize it as an expense, because the company is not actually or a revenue. The company is not receiving the money for their use. They don't have the right to use it. They don't recognize it as an expense. They are simply forwarding this amount. It's like channeling the amount, this payment from the customer to the tax agency. So basically the customer is paying the tax agency through the retailer. And basically this is usually presented in a percentage of sale. Like in New Jersey, in general, sales taxes are 7%. So if you go to Walmart in New Jersey, you will be paying 7% multiplied by the products, by the price of the products. The companies, they would either bring it up separately or include it in the total of the receipts. And at the end of the month, usually the retailer will take all these taxes and will remit them, or would forward them to the tax agency. This is not done on a daily basis because it's not very efficient. Instead, the companies would take this amount and would forward it to the tax agency at the end of the month. So to see how this works, the March 25th cash register reading for Cooley Grocery shows sales of 10,000 and sales taxes of 600. The journal entry that the company needs to enter, and here as we can see the tax rate is 6%. So the journal entry that the company will have to make is to record the event that happened. The event that happened is that the company received cash from customers for the value of 10,600. Although their sales revenue is only 10,000, this is the sales revenue, but they did also collect cash, so they have to record it. So the cash that they received was 10,600, which is made up of two parts. This is the sales revenue and tax. As a result, the company will debit cash 10,600, the company will credit sales revenue 10,000, and the company will also record a sales tax payable of 600. This is the amount that later on will be remitted to the tax agency. And when later on they send this money to the tax agency, the company will be paying cash to tax agency. So the company will credit cash 600 and debit sales tax payable 600. Here, as you can see, those two parts will more or less cancel each other. As a result, it is as if the company only received 10,000 in cash and recognized sales revenue 10,000. However, the 600 of sales taxes will be channeled through the company to the tax agency. A retail store did not ring up sales tax separately. If the sales tax rate is 5% and the total receipts amounted to 126,000, what is the amount of sales taxes owed by the taxing agency? Now, when we are asked to solve a question like that, we need to look at the question carefully. Here, the store did not ring up the sales separately. So this amount here is the total. So this is the total, which is equal to the sales plus, it will be equal to the sales plus sales tax. So in order to calculate the amount of the sales tax, a common mistake is people when they multiply this by 5%. This is not correct. The way to do it is that the total is equal to sales plus sales tax. Okay? So which is equal to sales plus 5% of sales. This is 5% multiplied by the sales, which is equal to sales plus 0.05 sales. And that would be equal to 1.05 multiplied by sales. So this is equal to 126,000, which is to mean sales is equal to 126,000 divided by 1.05, and that would be 120,000. This is sales. Okay, now in order to calculate the sales taxes, we can either multiply 120,000 by 5%, that would give us 6,000, or subtract 120,000 from 126,000. So it's either that or the difference between the total and the sales revenue, which is also equal to 6,000. Here, if you want to think about it differently, like in math or something, this one here, this part here, it's as if it's equal to, it's in the same way as if total is equal to x plus 5% of x, which is equal to x plus 0.05 x, it's equal to 1.05 x. So x is equal to the total divided by 1.05. This is the same way. Another kind of current liabilities are payroll and payroll taxes payable. Now, when we talk about payroll, we are talking about what the company pays to their employees in return for their work, and that would cover salaries and wages. And those two, salaries and wages, are basically the same. The main difference is the rate per which they are paid. For example, wages are usually per hour, compared to salaries, which are usually yearly or monthly rates. But they are treated basically the same. And when companies recognize salaries and wages, basically when they recognize their payroll, they recognize them as salaries and wages expense. And the calculation of salaries and wages expense would include basically to calculate the payroll, there are three amounts that are included. We have the gross pay, this is the full amount, this is the official salary, and then we have payroll deductions. Those are the amounts that the company will withhold from paying to their employees, and then they will remit to the various tax agencies. And then the difference between gross pay and deductions will be the net pay. So basically the net pay is the amount that the employees will receive after the deductions. Here, as you can see, the gross pay is this part here, that would be the gross pay, and this is the full amount. As you can see here, a part of it, this is a chunk that will go to the FICA as FICA taxes. You have also another chunk that will go to federal income tax. We have one that will go to state and city income taxes, etc. And whatever remains from after all these deductions will go to the employee, and that would be the net pay. This is the amount that will be actually on the paycheck itself. So let's see how the company would record this. Assume a corporation records its payroll for the week of March 7 as follows. So the company would recognize salaries and wages expense as the full amount. This is the full amount. This is the gross pay. And then the company will have deductions. Those are to be paid later on, to be remitted to various tax agencies, hence the word payable. Those are amounts that the company owes to various tax agencies. And we also have the net pay. This is the amount that the company now owes to its employees. This is the amount that will go on the paycheck itself. And on March 11, this is when the company actually makes the payment and sends out the check. The company will debit salaries and wages payable, the net pay, and will credit cash. The company basically, on this day, the company will actually pay its employees. So this is where the company is paying its employees the net pay, which is the amount that will go on the paycheck itself. Now, there is another type of payroll taxes that is paid by the employer and not the employee. Those are not the deductions. Those are not the same as the deductions that were basically taken from the employees' salaries and wages. Those are the amounts that will be paid by the employers. Those are, for example, for federal unemployment tax, state unemployment tax, FICA taxes, different from the ones that will be deducted from different from the amounts that will be deducted from the gross pay of the employees. So based on the corporation's $100,000 payroll, the company would record the employer's expense and liability of these payroll taxes as follows. Here it is called payroll tax expense. This is not salaries and wages expense. This is payroll tax expense. Those are the amounts that are to be paid by the employer. And in this case, for example, the amount is $13,850. They will be distributed according to these amounts. And those, those are the amounts that the company company owes tax agencies. And because and when they pay them, those liabilities will be debited to decrease them, and at that point the company will credit cash. In this course, you will not be asked to calculate those taxes, etc. Those are for more advanced courses. So, as a quick reminder, employer payroll taxes do not include federal unemployment taxes, state unemployment taxes, federal income taxes, or FICA taxes. Now, this is the only one that is not included because this is income tax, and usually it is deducted from this is part of the deductions, and it's not part of the employer's payroll taxes. So this amount will be taken from the gross pay of the employees, and not it will not be paid by the employer itself. Now, unearned revenues is a different kind of another kind of current liabilities, which we have covered before. To remind you of how this works, those are the amounts. This is when the company receives cash before they actually provide the service or deliver the goods. So they have received. So the company would have received cash before actually earning the money. So they did not earn those revenues yet. They did not provide the service. They did not deliver the goods. As a result, they did not earn the revenues, but they have received cash. As a result, the company will debit cash and will credit. So the company will debit cash and credit unearned revenue, which is a liability account. It's a current liability account because the company now owes this to the customers, owes a service, they owe a product or something like that. And if you remember, we talked about this we gave the example before of sports tickets, for example, tickets for games, etc. Magazines. The company, for example, who would publish a magazine, if a customer purchases a subscription for a whole year, and it is made up of 12, and this is a 12-volume subscription, the company will have received cash for 12 volumes. However, it will not recognize this amount as revenue until it has actually delivered the 12 volumes. And every time the company delivers one volume, the company will earn that amount. So it will debit unearned revenue and it will credit revenue. At that time, no cash will be exchanged, but the company would have earned this money or part of the money depending on those amounts. So let's see an example which would explain it better. Assume that Superior University sells 10,000 season football tickets at $50 each for its 5-game home schedule. Now the university will make the following entry for the sale of the season tickets. The company still did not earn this money because they did not play the games. But at the same time, they have received the cash. So the company made the sale, will receive the cash. As a result, the company will debit cash 500,000. This is $50 multiplied by 10,000 season tickets. But because it is the company did not earn them, the company will not credit revenue. Instead, the company will credit unearned revenue. And this unearned revenue, in this case, it is because the company the university did not play those games until this at the point in time where the sale was made. As a result, they will credit unearned revenue, which is a liability. Now, as a school completes each of the 5 home games, every time after each game, the company will recognize the company would have earned the revenue of that game. So at this point, the company will debit unearned revenue 100,000. This is for one game. This is revenue from one game, and then it will credit ticket revenue 100,000. This is the amount that the company has earned. At this point, the company's liability would have decreased because they have provided the service, or they have provided the good, which is in this case one game. So this amount will be done for after each game until the company has done the 5 games, and at that point the company would have earned the $500,000. So Pickett Company typically sells subscriptions on an annual basis. This is an example of a magazine, or based on a magazine that sells on a company that publishes magazines, and in this case it publishes 6 times a year. The magazine sells 60,000 subscriptions in January at $15 each. What is the journal entry that the company will make to record the sale of the subscription? At this point, the company has received cash 60,000 subscriptions multiplied by $15. So this is equal to $900,000. This is what the company will receive in cash. At the same time, the company did not earn any of this money. As a result, the company will record this as unearned subscription revenue. And as a result, the correct answer is B. The company will debit cash 900,000, will credit unearned subscription revenue 900,000. Now, current maturities of long-term debt. Sometimes people get confused about this because it says long-term debt. However, those are the long-term liabilities that will be maturing, or that will be due within 1 year or within one operating cycle, whichever is longer. And so basically those are the long-term debts that will be maturing and that will be due within 1 year of the date of the financial statement. Here, we don't need, the company does not need to make any adjusting entry to recognize it because it has been recognized. All the company does is they would put those current maturities under current liabilities, whereas they usually are, they move them basically from long-term liabilities and put them under current liabilities. So for example here, and usually on the statement, on the financial statement, the company would first put notes payable, because those they have formal proof. This is a formal promissory note. So the company will first put notes payable and then accounts payable. After that, the company will put them in order of magnitude. Basically, this is the amount that will be basically in decreasing order. Long-term debt due within 1 year is different. So here we have current liabilities. We have here, this is the total amount. We have non-current liabilities, and then we have stockholders' equity part of it. Usually, the companies would also include additional information in the notes, like regarding the notes payable, and they would also include the terms, etc. And they include this information in the notes to the financial statement. They don't include everything on the balance sheet itself because it could become too big and too long. Instead, they add this information in the notes. Once again, we need to calculate, or we need to analyze we need to analyze the information that the companies provide on their financial statements. And one important ratio that one important term that the companies look at is the liquidity of the company, which means that this is the ability of the company to pay its short-term debts. And at this point, and one way to look at this is by looking at the working capital. So the working capital is the difference between all the current total current assets, basically between the current assets and current liabilities. And while this is useful to analyze the liquidity of the company, it is not as good for comparison when you are trying to compare companies of different sizes, because this gives you an absolute number. So a working capital of, for example, $10 million could be good for a small company, but a working capital of $10 million for a company like Apple or Google would not be good. Another term that would provide a relative number would be the current ratio, which is the current assets divided by current liabilities. And here what it says, it simply says that how many, it tells us, for example, the size of current assets compared to current liabilities, and it gives us how many times the company's current assets can actually pay the current liabilities of the company. In this case, for example, the current ratio is 1.44 to 1, which is to mean that current assets would cover 1.44 times the company's current liabilities. And usually the higher the current ratio, the better it is. Generally speaking, a 2-to-1 ratio is a good it means that the company has a good credit rating. When it becomes lower than that, usually certain companies that even with a current ratio that is lower than that, it still depends on, still could be considered as good, depending on if the company improves management of it has a good management of their current assets and current liabilities. And like we said, because current ratio provides us with a relative information, current ratio can be used to compare the liquidity of companies with different sizes. So in this case, for example, a company that has in this case this number here, instead of looking at the number in absolute value. We are looking at ratio that would tell us at this point if you are comparing a company. Let's say that if Google had 1.44 current ratio compared to a small companies with 2 to 1 current ratio. 2 to 1 current ratio would be better. The company with 2 to 1 current ratio would be a better, would have a better liquidity than a company with 1.44 to 1 current ratio. Now we get to long-term liabilities, and the most common form of one of the most common forms of long-term liabilities is bonds. And bonds are a form of interest-bearing notes payable, and basically when the company issues bonds, they are borrowing money, and they make the promise to pay the full amount in addition to interest that is incurred because of this loan. And usually companies, they issue bonds when the amount of capital that they need to raise, this is basically, they do that in order to raise some capital, and when the amount of this capital is too large and it is a long term, so the company would want to borrow money, a large amount of money for a long period of time, they would issue bonds. And they have so companies, when they want to raise some capital, they have one of two ways. One of the two main ways of doing that, they would either issue bonds or they would issue stocks. Issuing bonds has several advantages over issuing common stock. This is called bond financing. This is when they when they raise capital by issuing bonds. The main advantages are that the control over the company will not change, because they are not they are not issuing new stocks, they are not having new investors, so the control over the company will not change. Bonds, they don't have any voting rights. The second one is that it is related to taxes. Interest that is paid will decrease the net income, and as a result, this income, this net income, which will be lower, it will be for less taxes. So this is mostly because the bond interest is tax deductible, not the main. This is the bond interest. So the interest is tax deductible. As a result, it will be deducted from the net income before paying taxes. And the third main advantage, and we'll see that in a second how this one works. The third one is basically that because we did not issue additional stocks, we have the same number of stocks that are outstanding. We have the same number of shares that are with shareholders. As a result, the earnings, net income that the company will make after paying all their taxes, etc., will be distributed on the same number of shares, and that would be basically the earnings of the company might be higher for every share. So earnings per share or EPS might be higher when financing using bonds. Now, one of the main disadvantages is that the company will have to pay back. This is a loan, so the company will have to pay back the full amount plus interest. So this is the disadvantage compared to issuing stocks for to finance or to raise capital. So this one here, this is an example of the difference between two plans. One of them is to issue stocks, the other one is to issue bonds. So let's say here, assuming that the income before interest and taxes was 1,500,000. So this is income before interest and before taxes. According to the company raises cash by issuing stock, the company will not pay any interest. So the net income, the income before taxes will be 1,500. Let's say here that income tax is 30%. That would be here, that would lead to income of 450,000. Net income in this case will be the difference between the two, so it's this one minus this one. It will be this amount here, and as a result the net income here is 1,050,000. Let's look until this part here. Let's look at the second option. The second option is where the company will be issuing bonds. In this case, the company has paid interest 400,000, so the taxable income is 1,100,000. Out of this, 330,000 will be in taxes, so the income before tax is, so the income here before tax, no, I'm sorry, this was the income before tax is 1,100,000. After deducting tax expense of 30%, we end up with the net income. So here the net income is lower, so lower net income. But this lower net income is divided by 100,000 shares compared to this higher net income, which is divided by 300,000 shares. So it's divided by 300,000 shares. So in this case, earnings per share would be 3.5 compared to 7.7. In this case, in this specific example, issuing bonds would lead to a higher earnings per share than issuing stocks. Remember, when you issue stocks, you have more investors because you basically you have here more outstanding shares instead of 100,000 shares. In this example, the company has issued 200,000 shares to raise the same amount. So now there are different types of bonds. You have secured versus unsecured bonds. Secured bonds are bonds where the company has some kind of an asset, some kind of assets, or that the issuer of the bond, this is the company that is borrowing money, they would pledge as collateral. So for example, the company might have a mortgage. They would have this as a collateral in case they defaulted on the payment. Unsecured bonds, also known as debenture bonds, this is when the company issues bonds against their own credit. If the company has a good reputation, they might be able to issue bonds and sell them strictly based on their reputation. Now there's also term and serial bonds. Term bonds, they would mature all at once at a specific period of time. So this is when the whole amount will be paid at specific date in the future. Compared to serial bonds, this is where the payment is done in installments. Again, those depends on the terms of the bonds. We have also registered and bearer bonds. Registered bonds are registered to a specific person or company. So you have the name of the owner. It's registered on the bond. Bearer bonds, sometimes also they are called coupon bonds. Those are bonds that where they are not registered to any specific owner. They are basically whoever has them will be able to basically to sell them or to use them. There's also convertible and callable bonds. Convertible bonds have the option of being converted to common stock, which is sometimes depending on the bond owner, if they want to convert it to from bond to common stock, which is sometimes it is very appealing to investors or to people, to lenders. Because they can become partners rather than they can become shareholders rather than just being holding those bonds. And this is mostly when the stock price is favorable to their to the bond owner. Callable bonds are bonds where the company who issued them, this is the company who is borrowing the money, the company who is issuing those bonds has the right to retire them before they are actually before maturity. So this is before they have matured, the company has the right to retire them, and basically it's, they will have to buy. They have the right to buy them back prior to maturity. So this is basically the same thing. We have here secured bonds versus unsecured bonds, where you have no assets as collateral. Here, for example, you have a building or you have some kind of an asset. You have convertible bonds. We have also callable bonds. Now, how does a company issue bonds? The way the bond issuing procedure, the way the bond issuing happens follows this procedure. First, the state would have to grant the corporations the right to issue bonds, and then the board of directors and the stockholders, they have to approve of issuing bonds. Remember that the company is borrowing money, and as a result, it is incurring probably a certain sum of money as interest. And as a result, both the board of directors and shareholders will have to approve issuing those bonds. Once this has been approved, the board of directors will decide on the number of bonds to be issued and the terms of bonds, basically. So the number of bonds that will be authorized, the face value, as well as the contractual interest rate. This is the interest rate that will be paid to the lenders. And later on, the company will issue a certain number of bonds. Most of the time, this number of issued bonds is lower than the authorized number of bonds. The reason is that board of directors and this would take into consideration future needs of the company's management, of the companies basically. As a result, they will authorize a higher number of bonds to be. They will authorize a higher number of bonds that would take into consideration future needs as well. And this information regarding the bond and the contract rate, etc., is all found in a legal document that is called bond indenture. This is not the bond certificate itself. The paper certificate, which we will see in a few minutes, this one usually indicates the number of, basically it indicates the face value and the contractual interest rate, but the bond contract is the actual amount that would include various information. The paper certificate is usually done for a face value of $1,000, and usually what it says, this is basically a promise to pay the full amount after on maturity date. Basically, this is on a specific date in the future, as well as interest amounts that are usually paid periodically. Most of the time it is semi-annually, which is to mean it's every 6 months, and usually this is stated and this is according to the interest rate, the contractual interest rate, which is stated on the certificate itself. And this is usually done when the company, like we said before, this is usually done when the company requires a large amount of money. And the amount of money at that point, because the capital is too large to be borrowed from a single lender, the companies would issue bonds, and at this point they will be able to raise cash or to raise capital from all the people who will be buying those bonds. This is how the bond certificate looks like. So in this case, this is the bond certificate, not the bond indenture, not the contract. This is the bond certificate. It would indicate, for example, the issuer of the bond here. It has the name. If it was registered, it would have the name of the person here. It would be, if it is registered to someone, it will show the name of that person. This is the interest rate here. Those are numbers. So it also mentions the maturity date. This is the due May 1st, 2017. This is the signature of the company, of the chairman of the board who authorized the bond issuing. And usually it says also here the face value of the bond. This is here, it's the face value of the bond. Now it is important to remember that bonds, they are traded on the securities exchanges. So basically they are traded on a daily basis, and the price, the market value of those bonds may be different from the face value of that bond. Again, this is very similar to depends on the demand. This depends on various issues, mostly demand and supply. It also depends on the interest rate, the contractual interest rate, compared to the market interest rate. And usually this information is published on a daily basis to show the trading activity of these bonds. Like for example here, the way it is read here is that Boeing, this is the company. So Boeing, they have outstanding 5.125% of the bonds. The face value is $1,000. Maturity date is 2014. It is February 15, 2014. The yield is 5.747% of the return yield. And on this day, the volume that was traded is 33,965,000 bonds were traded on that day. The closing price was 96.595. This means it is 96.595% of the face value, which is to mean here it is $965.95. So although the face value is $1,000, the market value of that bond was actually lower. It was $965.95 on that specific, at the closing time of that specific day. Now, the market value of the bonds, this is the price at which the bond will be traded on the securities exchanges market. So which, like we mentioned before, might be different from the face value, will depend on several factors. The main three factors that will affect the market value of the bond are the amount of money that the company will the amount of money to be received. This is how much will be received. The other one depends on the maturity date. This is basically how long it is until it will take until maturity date. For example, a bond that will mature in 10 years will be different. The value of that bond will be different from a bond where it will mature next year. So here it depends on maturity date. So this is length of time until the amounts are received. This is depending on the maturity date. And finally, it also depends on the market interest rate compared to the contractual interest rate. So the contractual interest rate is the interest that is on the that this bond will be paying. On the other hand, the market interest rate, this is the rate, this is the interest rate of the bonds that are being paid by similar bonds in the market. So basically, this is the rate that investors are asking for in order to lend the company this money. So basically, this is how much is expected in return of the money that will be borrowed by the company. Remember, when the company issues bonds, the company is borrowing money, and market interest rate is the interest rate that those investors or those lenders will expect in return of this in return of lending money to the company. There are other factors that will also affect. Those will be depending on the features of the bonds, such as convertible bonds, callable bonds, etc. Those will also have some effect on the market value of the bonds. Now, how do we record issuing bonds and selling bonds, etc.? So when the company is dealing with bonds, the company will record transactions when the company issues the bonds, or retires or redeems the bonds, or when the bondholders convert them to common stock. If a bondholder sells the bond to another investor, the company will keep track of the owner of the bond in order to send them the interest later on, but the company will not make any journal entries for the sale of that bond, because in this case it will be between investor 1 and investor 2. As far as the company is concerned, the company sold the bond to an investor, to a certain investor. They don't really care who this person is or who this company is. They only care to know the name of that owner of the bond in order to send them the interest. But what will actually be recorded, the company will record the sale of a bond. This is when the company issues the bond, or when the company buys it back. This is when the company retires the bond. And the third type is when a certain if a bond that is a convertible bond, the company would record converting the bond to common stock. Those are the events that will change the financial position of the company. Those are the events that will have to be recorded and recognized and journalized by the company. Now, the companies might issue bonds either at par, at a discount, or at premium. Now, when the company issues the bond at par, it means the interest rate of the bond is equal to the interest rate of the market interest rate. Generally speaking, well, the discount and the premium, those are the difference between the face value and the selling price of the value. If you remember in the previous example, a few slides ago, Boeing was being sold at 965.9 something, and that amount was the difference between that amount and the face value of $1,000. That would be a discount because it was sold at a price lower than the market value. So it was sold at a discount. When the company sells it at a higher, the company will sell it at a premium. So when the companies in this example here on this slide, the companies so the bonds interest rate, the contractual interest rate is 10%. This is how much the bond will earn the owner of the bond in interest. So every year, the owner of the bond will receive 10% of the face value. So this is 10% of face value every year. Let's say that similar bonds in the market are offering 8%. So this is from similar bonds in the market. They are offering 8%. As a result, the company will be selling the bond. So this bond here will be sold at a premium. So the company will be selling its bond at premium because it is providing more higher interest than the market. Think about it this way. The company, if company A, in this case, company A has a bond of 10%. Company B has a bond of 8%. Which one would you be more interested in investing? You would be interested in investing in this one, right? So at this point, the company will say that, okay, my bond is better than any other one in the is better than the markets in general. As a result, I will sell you mine. I will give you 10%. However, instead of selling this bond at face value at $1,000 or face value, so this one is face value, the company might say that instead of paying it as face value, I will sell it at a premium. I want for this one, instead the company might ask, for example, for $1,050. So this extra $50, this one is a premium. So the company here knows that its bond is better than the markets, than the other bonds in the market. As a result, they would ask for a premium to sell it, and this is why they say that the bond was sold at premium. When the company issues the bond at 10% and the market interest rate is 10%, it will be the same, so the company will be selling it at face value. When the company issues the bond at 10% and the market value is 12%, the company will issue it at a discount. This one here is the other way around. In this case, what happens is that the company knows that its bond is basically worse than other bonds in the market. And because they don't want to, their interest rate cannot, it is a contractual interest rate. It was decided when the bond was issued, so they cannot change it. So the interest rate is lower. So the bond yields lower interest than the market. As a result, the company, to motivate, they will sell it. The company will sell it at a discount. At discount, basically to encourage lenders or investors to buy it. So what the company is doing, basically, they are, in order to motivate investors and lenders to buy this bond, the company will offer them the bond at a discounted price. This is the same example that we had with the Boeing earlier. Let's see how this works. On January 1st, 2014, Candlestick Corporation issues $100,000 5-year 10% bond at 100, and when we say at 100, it means at 100% of face value. The entry to record the sale is here. This is the entry to record the sale. So when the company made the sale, the company issued $100,000 worth of bonds. When the company issues them, basically the company is selling them. So the company will receive cash $100,000. So the company will debit cash $100,000 and will credit bonds payable $100,000. Remember, this is a long-term liability. Now, on January 1st, this is the same one. Now we assume that the interest is payable semi-annually. So the company will pay interest on January 1st and July 1st. We need to prepare the journal entry to record the payment interest on July 1st. So on July 1st, the company will pay interest. Now, how do you calculate interest? Like we did before, interest is always the interest rate multiplied by the face value multiplied by the time in years. So here it is 10% of 100,000 multiplied by, it is semi-annually, which is to mean 6/12. And this will be equal to $5,000 this is the semi-annual interest payment. And this is an interest expense, so the company will recognize this expense by debiting interest expense, 5,000, and crediting cash, 5,000. Now, we need to prepare the payment to record the accrual of interest on December 31st. Remember that it is paid on January 1st. So on December 31st, it's not paid, so interest expense should be recognized, but won't be paid. As a result, again, it's the same thing, it will be 5,000. As a result, the company will recognize interest expense, so they will debit interest expense, 5,000, but the company in this case, it will recognize the accrued interest by debiting interest payable, by crediting interest payable. In this case, this is the amount that the company will have to pay when on January 1st, but the company on December 31st will have to recognize this expense. They are not going to pay it, so they will simply credit it to interest payable. So far, this is issuing bonds at face value, because here it was issued at 100, which is to mean at 100%. Now, when the company issues the bonds at a discount, the sales price will be lower than the face value. So here, on January 1st, 2014, Candlestick Inc. sells $100,000 5-year 10% bonds for $92,639, which is to me it's 92.639% of face value. Interest payable again is July 1st and January 1st. The entry to record the issuance, once again, when you say that to record the issuance, it means to record the sale of the bond. The company, remember, it is important to remember something. Whenever the company issues bonds, the company will be receiving cash in return for bonds payable. The amount of cash received will be for the selling price. So the company will debit cash, $92,639. This is based on the selling price. The company will, at this point, the company will also need to debit the discount between the difference. So the company will also credit, let's do this, the company will also credit bonds payable always at face value. So bonds payable is credited at face value. This one here, this amount here is the difference between the two. Because the selling price is lower than the face value, this will be a debit to discount on bonds payable. So whenever the company is selling bonds at a discount, you debit cash, the selling price, you debit the discounts on bonds payable, the difference between the face value and cash received, and then you credit bonds payable at face value. Now, this account here is a contra account. It will be deducted later on from bonds payable. So this is how it will look like on the statement. You have long-term liabilities, we have bonds payable less discounts on bonds payable. So this is what we call the carrying value. This is like the book value. This is the value of the bonds according to the company's books. It's called carrying value. So, and that would be, the carrying value is the difference between the bonds payable and the discount. So it's bonds payable minus discount on bonds payable. And it is important to see that the discounts on bonds payable will increase the cost of borrowing. Why? Let's see how this works. The thing is that the company is paying this, is basically accepting less money than the face value. So the company is accepting this discount up front. The company is getting $92,639, but when on maturity date, the company will be paying the face value of $100,000. This is why the cost to borrow the money has increased. And let's do this one by one to see how this is calculated. So here there are two ways of calculating this. Let's do the first one first. The company will be making payments. So the company will be making payments, interest. Those are the amounts that the company will be borrowing the money will cost the company. It is basically the semi-annual interest payment in addition to the bond discount that the company had to endure in order to borrow this money. This is 50,000 semi-annual. It is, like we said here, it is 10,000 multiplied by 10%, 100,000 multiplied by 10% multiplied by 6/12, which is 1/2. That will be 5,000 per year, per payment. It is 5 years, which is to mean 10 payments. This is 5 times 2 payments, so 5 years times 2 payments per year. That would be 10 payments. As a result, it will be 50,000 plus the discount, and that would be the cost of borrowing money is 57,361. Another way of thinking about it is by looking at how much the company will have to pay on maturity and how much the company actually got cash. The difference between the two will be the cost of borrowing. So the company on maturity date, so the principal at maturity, it will be the face value. This is the interest amount. It's calculated in the same way. This is the cash that the company will be eventually paying to the bondholder. This is whatever the company will pay until the day of until maturity. It will be the face value plus 10 payments of 5,000. It's 150,000. The company, the amount of cash that the company will receive at the beginning when they sell those bonds is 92,639. This is the amount of cash that the company will receive. As a result, the cost of borrowing money will be 57,361. If the company had borrowed money at par, remember, it could have sold those bonds at par. At this point, when it is at par, we don't have a discount. So the amount when it is at par, the cost of borrowing money will be 100,000. This is the face value, plus 50,000. This is the interest. This is the amount of money that the company will pay. The cash received will be $100,000. As a result, at that point, the company's cost of borrowing will be the interest will be 50,000, and that would be the interest paid. This would be the difference between would be the cost of borrowing $100,000 at par. So this is at par here, not to be confused with the ones below which are at discount. Again, as a quick reminder, how do we calculate working capital? Is it current assets minus current liabilities, total assets minus total liabilities, long-term liabilities minus current liabilities, or current assets divided by current liabilities? And the answer is current assets minus current liabilities. The last one, which is current assets divided by current liabilities, this is the ratio. If you remember, this was the current ratio. So this one is current ratio. Now, the major disadvantages resulting from the use of bonds for financing will be that interest is not tax deductible and the principal must be repaid, that the principal is tax deductible and interest must be paid, that neither interest nor principal is tax deductible, that interest must be paid and the principal must be repaid? Well, the answer is D, because interest is tax deductible, principal is not tax deductible, so this was not correct, this is not correct. That neither interest nor tax or neither interest nor principal is tax deductible, that's incorrect. Interest, the main advantage is that the company will have to pay back the money that it borrowed. This would be the principal, in addition to the interest that will be incurred, basically semi-annual or something like that. Now, discount on bonds payable, it has a credit balance, is a contra account, is added to bonds payable on the balance sheet, it increases over the term of the bond. The answer is B, it is a contra account, and it is, as a result, it has a debit balance, and it will be deducted from bonds payable and not added to bonds payable. Companies can also sell bonds at or issue bonds at premium, and this is when the selling price of the bond is higher than the face value. So in this example, on January 1st, 2014, Candlestick Inc. sells $100,000 5-year 10% bonds for $108,111. The selling price here is greater than the face value. Interest is payable on July 1st and January 1st. The entry to record the issuance is, remember, when the company to record the issuance, it means this is when the company is this is when we record the sale of the bond. In this case, the company will receive, we need to remember that we need to debit cash, the selling price. So cash will be debited 108,111. This is the selling price. The company will credit bonds payable 100,000. This is at face value. So remember, you always debit cash, the selling price, credit bonds payable, the face value, whenever you are recording issuing. The difference between the two will either be a premium or a discount. In this case, the difference of 8,111 will be credited to premium on bond payable. This is basically the difference between the two, between the face value and the selling price. And the way this is presented on the statement, this is added to the bonds payable, and premium, when the company issues bonds at premium, this premium is said to be lowering the cost of borrowing. It will decrease the cost of borrowing to the company because the company will be receiving this premium on bonds payable in advance. As a result, the company will be eventually paying less. It will cost the company less to borrow the money. Now, why do we add the premium on bonds payable? Because at this point, it is unamortized, and we will learn later on that how to amortize bond premiums and bond discounts. And here it is important to remember something. This premium is associated with the money, with the bonds payable for the life of the bond. As a result, it has to be amortized over the life of the bond. This one here is also the carrying value of the bond. So this is the carrying value, and this is the carrying value, and this premium here, this is the unamortized premium. This is the amount of premium that the company did not amortize yet. We will talk about amortizing premiums later on, but this is the amount that the company needs to allocate or to associate with the life of the basically it needs to allocate it to the life of the bond itself, because this premium is decreasing the cost of borrowing overall the period of time, and not only at the time of selling or at time of issuing the bond. This is why it is added at this point, because it has not been amortized yet. At the end of the time, when at maturity, basically, when the bond is to be redeemed or retired, at that point the company would have amortized all the premium, and at that point it will not be added to bonds payable. Here, this is again, it's the same way. So let's do the one here. The company, once again, the cost to the company will be the face value and interest. The company, when it issues the bonds, will receive 108,000, and as a result, the cost of borrowing money will be 41,889, which is less than the 50,000. It's less than 50,000, which would be cost at par if the company had issued it at par. So Carson Inc. issues 10-year bonds with a maturity value of 200,000. If the bonds are issued at a premium, this indicates that the contractual interest rate exceeds the market interest rate. The market interest rate exceeds the contractual interest rate. The contractual interest rate and the market interest rate are the same. There is no relationship between the two rates. And the answer is A. When the company issues the bonds at a premium, it means that the bond's interest rate, which is the contractual interest rate, is greater than the market interest rate. If the market interest rate is greater than the contractual interest rate, the company will be selling bonds at a discount. This is, if you remember from this one here, when the contractual interest rate, this is when the contractual interest rate is higher than the market interest rate. At this point, it will be sold at a premium. Now, the other time, so we talked about selling the bonds or issuing the bonds. Now we will talk also about redeeming or retiring the bonds. This is when the company redeems the bonds at maturity. The company will have to pay the full amount, the face value, in addition to any accrued interest if they still had. But usually the company will be recording interest payment separately from redeeming the bond, from actually paying back the bond's face value or the principal. So the company, when the company redeems the bond at maturity, it will debit bonds payable, the face value, and credit cash face value as well. This is separate from the interest payment. So the interest payment is separate from that amount. So this is separate from, again, this is at face value. And it is recorded separately from that amount. This is different from notes payable that we studied before, or notes receivable, when the company would have to pay the full amount plus interest. That was for short-term notes payable and notes receivable. When we are dealing with bonds, interest is being paid semi-annually. So when the company redeems bonds at maturity, the company will be paying the face value and will be recording the payment of the face value or redeeming the bond separately from the payment of the interest. When the company redeems the bond before maturity, in this case, the company will have to first eliminate the carrying value of the bond This is basically the carrying value is the difference between the face value and any unamortized premium or discount. The company will also record the paid cash because the company will pay cash, and the company at the end will either recognize a gain or a loss on redemption, depending on whether they sold it at a price that is higher than carrying value or lower than the carrying value. So the carrying value, this is the difference between the face value and any unamortized bond discount or bond premium. If it was a bond discount, it will be face value minus unamortized bond discount, or it will be face value plus unamortized bond premium. This is what the carrying value is. So let's see how it is recorded. Assume Candles Inc. Has sold its bonds, 100 bonds, at a premium. So here the bonds were sold at a premium. At the end of the 8th period, Candlestick retires these bonds at 103 after paying the semi-annual interest. So as like we mentioned, interest payments are done separately. In this case, they have been paid before they were retired at 103. So the company is selling them at 103. The carrying value of the bonds at the redemption date is 101,623. This is the carrying value. Candlestick makes the following entry to record the redemption at the end of the 8th interest period. Remember, we don't include interest because it has been paid in advance. First, we need to record, this is again the company is paying in cash for bonds payable. So bonds payable will be debited at face value. It's always at face value. We always record them at face value. Now, what about the carrying value? Because the company had sold it originally at premium, we will also debit premium. So we will also debit premium, the same, basically the difference between the carrying value and the amount. Now the company has paid in cash 103. So the company here has paid in cash 103,000. This is 103, as you remember from here, multiplied by, so 103% multiplied by the face value, and this is basically this is the think about it as redemption price. This is the amount that the company will be paying in cash. This is the amount of cash paid. It's 103,000. The amount, those two are. So those two are the carrying value. If you remember from the previous slides, it is the face value plus unamortized premium on bonds payable. So this is basically the unamortized premium on bonds payable. The amount remaining was 101. Here the carrying value was 101,623. That means any difference between the face value and this amount will be premium, or will be premium. So here it is 1,623. The two together are 101,623, but the company has paid 103,000. So basically the company paid 103,000 for something that is, according to the company's books, is valued at 101,623. As a result, the company paid more than the value of the bonds. This is why the company will recognize a loss on bond redemption. So it will debit loss on bond redemption. The difference, this is the difference between paid cash and carrying value. Let's see an example here. 4,000 bonds with a face value of $1,000 each are sold at 103. The entry to record the issuance is. Now, whenever we have a question like that, we need to think about the amount, or whether it was sold at a premium or at a discount, and the amount of cash that will be received. The company has issued bonds, so they are selling bonds at 103, which is to mean because it is greater than 100, it would be a premium. We know that it is a premium. Here, the company will receive cash will be equal to 103. Basically, it will be equal to 103% multiplied by $1,000 multiplied by the 4,000 bonds. It was 4,000 bonds, and that amount will be 4,120,000. Out of this, the company will debit cash 4,120,000, will credit bonds payable always the same at face value, and the difference between the two will be a premium. So the correct answer is A. So remember, this is at face value, this is at selling price, and this one is the difference. Now, we could have also answered it by process of elimination. We know that bonds payable are never they are always at face value, so this one is incorrect. This one is also incorrect. And plus here we have total total credits are different from total debits, so this one is definitely wrong. This one is wrong. We know that the company sold the bonds at a price greater than the face value, so it is not a discount, it is a premium. This is another way of solving this question. This is another example of recording a redemption of bonds. So Lahey Corporation retires its 800,000 face value bonds at 105 on January 1st, following the payment of annual interest. The carrying value of the bonds at the redemption date is 829,960. So the entry to record the redemption will include one of the following answers. Whenever we have a question like that, the best way to answer it again is to write the actual journal entry. So in this case, the company is redeeming or it's retiring their bonds. So it means they are basically buying it back. The face value is 800,000, but they are retiring it at 105. So the price that the company will be paying, the cash that the company will be paying, will be 105 multiplied by 800,000. So we know that cash will be credited 840,000, which is equal to, so cash paid will be equal to 105 multiplied by 800,000, and that would be 840,000. So the company is paying 840,000. The company will also debit bonds payable face value 800,000. The company will also need to eliminate any unamortized discount or premium. In this case, it was originally purchased at a premium. Remember here that the carrying value is greater. So the carrying value is greater than face value, which is to mean it was sold at a premium. So the difference between this amount, so carrying value minus face value, will be equal to the premium, to the unamortized premium. In this case, it is 29,960. So the company will also debit premium 29,960. This is 29,960. And the difference between those two are again the carrying value. So the difference between the difference between the carrying value and the cash that was paid by the company will be either a loss or a gain. In this case, because the company paid more than it values those bonds, the company will debit loss on bonds payable, the difference between the two, which is 10,040, sorry, 10,040. As a result, the correct answer is B. Like I said, whenever you have a question like that, it's much better to write the journal entry and then see which one of these fit your journal entry. So, like we mentioned before, there are certain bonds that have the option of being converted to common stock. Those are convertible bonds. In this case, the company will keep paying interest until the bondholder or the bond owner decides to convert them to common stock. But until that point, bondholders will still receive interest payments semi-annually. As far as the issuer is concerned, this is the company. The company usually can put a higher price on such bonds. Those bonds are appealing to investors and lenders. So those bonds, they usually sell at a higher price, and they also pay lower interest because of this. Because they are convertible, they are usually sold at higher prices, although they pay a lower rate of interest. But they are attractive they are attractive to many investors. So for the company, it is sometimes it's a good option to have this, and for the on the other hand, for the investors also, it could also be appealing because they can convert it into stocks whenever the stock price is favorable to them. Once the company converts them, the company will transfer the carrying value. Basically, the carrying value will be transferred to paid-in capital. We will talk more about paid-in capital in the next chapter. The company will not recognize a loss or a gain. Any difference between, because this is at this point it becomes between the company and the stockholder at that point. And when the company converts bonds to common stocks, the journal entry will ignore the bond market value as well as the common stock market value. What will be recognized, we will see in a second how this is recorded and how the journal entry, but it is important to remember that the company will ignore the market value of the bonds and of the stocks. So on July 1st, Saunders Associates converts $100,000 bonds sold at face value into 2,000 shares of $10 par value common stock. Both the bonds and the common stock have a market value of $130,000. Saunders makes the following entry to record the conversion. Now the company is converting bonds that were sold at face value. So in this case, the amount that the company will debit, so the amount that the company is converting is $100,000. Those are bonds. So with debit, bonds payable, $100,000. The company will credit common stock. So the company will debit common stock 2,000 shares of $10. That would be $20,000 for common stock. The difference between the two is paid in capital in excess of par value. So let's walk through this journal entry. The company is converting bonds. It's converting those bonds into common stock. As a result, the company's debt will be turned into common stock. So the company will be debiting bonds payable, because it's basically paying those bonds payable with common stock. So the company will debit bonds payable face value. The company will credit common stock at par. We will do more of that in the next chapter, but it's always at par. So this is the par value. 80,000 is the difference between the carrying value and common stock at par. You always, whenever the company is converting bonds to common stock, you will debit bonds payable, you will credit common stock at par, and the difference is credited to paid in capital in excess of par value. Let's see an example of how this happens. Colson Inc. converts 600,000 of bonds sold at face value into 10,000 shares of common stock, par value $1. Both the bonds and the stock have a market value of 760,000. What amount should be credited to paid in capital in excess of par as a result of the conversion? Once again, whenever we have something like that, it is best to write the journal entry. So the company is converting 600,000 of bonds payable. So bonds payable. So the company will debit bonds payable, will be debited 600,000. The company will credit common stock $10,000, and this is basically it's 10,000 shares multiplied by $1 par value. The difference between the two will be credited to paid in capital in excess of par. That would be 590,000. So the correct answer is C. It is important to note here that we completely ignored the stock value and the stock market value and the bond market value. Now, you might ask, for example, why would anyone convert bonds payable who are worth 600,000 into common stocks for the value of $10,000? Now remember that this is a par value. This is par value. This is not the market stock value. So although the market value, although the stock value, although the par value of the common stock is $1, it is actually $76 sold at $76 in the stock market. So par value of common stock is equal to $1. Is equal to basically $1, whereas the market value of the common stock is equal to $76, and this is basically 760,000 divided by 10,000. This is 760,000 divided by 10,000. So the actual value of the stock in the market is $76, although the common stock, the par value of common stock is $1. We will talk about this more in chapter 11. And however, this is why someone would be converting $600,000 worth of bonds into $10,000 common stock. However, in reality, they are worth more than that. They are in the market, they are worth more than that. This is why convertible bonds are appealing to investors as well. Now, Bryce Company has $500,000 of bonds outstanding. The unamortized premium is $7,200. If the company redeemed the bond at 101, what would be the gain or loss on the redemption? Once again, we need to write the journal entry. So the company will be paying in cash 101 multiplied by, so the company will be crediting cash paid will be equal to 101% multiplied by 500,000, which is 505,000. So the company will credit cash 505,000. The company will debit bonds payable as usual, face value 500,000, and the company will also debit premium on bonds payable, the value of 7,200. This is the value of unamortized premium, 7,200. So this is the carrying value. This is paid cash. The difference between the two will be either a loss or a gain. Here the company is paying 505,000 for bonds that the company values at 507,200. The company values them at 507,200. As a result, the company will recognize a gain for the value of 2,200. This is basically the difference between this is basically carrying value minus cash paid. As a result, the company will be recording a 2,200 gain. Another type of long-term liability is long-term notes payable. Well, this is very similar to the notes payable that we have covered before. However, this is for extended periods of time. Many of them, they would have, for example, a certain asset as a collateral. For example, like they can be secured by an asset such as mortgages, and usually most of the time the terms of the loan would require the borrower to pay a certain installment, basically let's say a monthly installment or something like that. So every installment would be part interest and part principal. That is the original amount that was borrowed from using that notes payable. Here the reason here is that it will be the interest will be paid because it is for a long period of time. The lender, the creditor, maybe basically in order to secure that they will receive the money, they would require the borrower to pay in installments. And here basically what they will be paying, like I said, part of the principal or the original loan and part of the interest. This is to reduce the principal and to start and at the same time pay interest. And initially when the company signs a notes payable, they would record it at face value, and then later on it will they will record the mortgage notes payable at face value. Now let's see how the payments would change. So Porter Technology Inc. issues a $500,000 12% 20-year mortgage note on December 31st, 2014. The terms provide for semi-annual installment payments of $33,231. They do not include real estate taxes and insurance. The installment payment schedule for the first 2 years is as follows. And like I said, in this example, it is semi-annual. This is very similar to, this is the same as when someone buys a house and they pay mortgages on a monthly basis. This is basically the same concept. And each monthly payment, the person who buys the house, who is the borrower, will be paying part of the principal, which is the actual price of the house, in addition to a certain amount that will be the interest expense. So that will be the interest expense that it will be paid. So here the installment is to be $33,231. This one does not change. It will always be the same amount. However, the composition of this amount will change. Basically, this amount is two parts. Will be a certain interest amount plus reduction and principal. So once again, you need to prepare a table like that if you are to answer the questions. The company has issued a $500,000. So initially the company will record it at face value, and then later on we need to calculate the interest. The interest here is 12%. So the interest expense is this amount here is 12% multiplied by 500,000 multiplied by 6/12, because it was semi-annual. And this amount would be equal to 30,000. So it is actually 12% multiplied by the balance in the principal. So this will be 30,000. The installment is 33,231. This one minus this one will be equal to the reduction. This is the reduction in principal. Now the principal balance will be the original balance. This one minus this one will be equal to 496,769. For the second payment, the amount will always be the same. This amount will always be the same. What will change is the interest expense. Now the interest will be multiplied by this. It will be 12% multiplied by 496,769 multiplied by 6/12, and that would be 29,806. Again, this one, so the cash payment, this is the installment, minus the interest expense will be the new reduction in principal. So the reduction of principal is 3,425, and once again we have this one minus this one will give us 493,344. Once again, this is the amount that will be multiplied by 12% multiplied by 6/12. So this one is multiplied by this amount, and that would give us the new interest expense, etc., etc. And this is how we continue to record the differences between this is how we continue to record the interest expense and the reduction of principal. As you can see, with each payment, the amount, the cash payment is always the same. However, with each payment, the interest part of it will decrease. The principal part of it will increase, and this is why if you buy a house, it is always you will always basically lose more if you sell it like say after a short period of time after you buy it, because at that point you would be mostly paying the interest expense and your principal would not have decreased significantly. But with time, the reduction of principal will keep increasing to the point where at the end of the payments of installments, you would have paid all the principal. So Porter Technology Inc. issues the 500, etc. This is the same, but here we need to record the installments to make the journal entries for the first 2 years. To record, first we need to record the signing of the note. This is the signing of the note. The company would have received cash. The company has received cash 500,000. They issued 500,000, so the company received 500,000. As a result, the company will debit cash 500,000, will credit mortgage payable 500,000. So far, the company did not pay any interest. On at the end of the first 6 months, so at June 30th, let's say that the installment is to be paid on June 30th. As you remember here from this table here, it's June 30th. So on June 30th, the company will be paying interest expense. Those are the amounts. So the company will be paying 33,231, out of which 30,000 are interest expense, 3,231 are the reduction in principal, which is basically the loan itself. So the company will be, in this case, the company will be debiting interest expense 30,000. The company will also debit mortgage payable 3,231 and will credit cash 33,231. So this is the installment payment. This is each installment. This is the payment. This is the interest expense, and this part is the actual. So this is the interest part, and this is the actual loan, which is in this case reduction. This is the reduction in principal. So let me do that again. This one is the installment. So this is the payment. This is the semi-annual payment. This one here is the reduction in principal balance. So this is the actual, basically paying the actual loan. This is paying the amount from the actual loan. The way this is presented on the way the companies would present long-term liabilities, the companies would actually include bonds payable, along with, for example, some of the terms. They would also include whether they had a discount or premium, and as well as notes payable. In many cases, the companies would keep detailed information in the notes rather than putting everything on the balance sheet. They would put the detailed information as a schedule in the notes of the company. Once again, we get to analyzing this kind of information. There are two main ratios that creditors and investors, they look at when they analyze the ability of the company to meet its obligations, basically the ability of the company to pay its debts, and those are debt to total assets ratio and the times interest earned ratio. So basically the first one would tell us if the ability, basically it tells us the ability of the company to meet its obligations and to pay its debts as well. And the second one tells us the ability of the company to pay the interest that it has to pay. And this is important mostly for people who are lending the company money, because they want to know whether they are going to get their interest paid or not, and eventually whether they are going to get their loan back. So if it was basically the face value of the bond or the note payable, they want to know if they are going to get their money back. How do we calculate that? Kellogg had total liabilities of of 8,925 million, total assets of 11,200 million, interest and expense, income taxes, etc. Now, debt to assets ratio is simply where we divide total debt by total assets. Now, debt to total assets ratio, it tells us the part of total assets that comes from borrowing money. Basically, this is the part of assets that the company has borrowed. Here, for example, the total debt is total liabilities 8,925 divided by total assets, and that would tell us that the company, basically 79.7% of the company's assets, they come from debts. And the higher the ratio, the worse it is, or the higher the risk for the company not to be able, for the company that the company would default on those payments. So basically, the higher this ratio, the debt to total assets ratio, the greater the risk that the company will not be able to pay back their debts. And the second one, which is times interest earned, we look at the income before income taxes and interest expenses. So when here we have to add back income taxes and interest expenses to the net income. Remember, net income, here we have that the company's net income. It means that the company has already paid taxes and interest expenses, so we have to add them back. So it's income before income taxes and interest expense. We divide it by interest expense, and that would tell us that the company during that year can pay 6.71 from the net income. Basically, the company can pay its interest 6.71 times. So the company has earned 6.70 times the interest that it has to pay. Now we get to amortizing bonds discounts and bonds premium. This is, as you can see, it's an appendix, and it's and here there are several ways of actually amortizing bond discounts and bond premiums. We will focus here on one of them, which is straight line method of amortization. And similar to like before, like when we did with a straight line method of depreciation, we will divide this bond discount by the number of interest period. This is basically the number of payments. Let's say that, like we said, it was a 5-year bond, and it was interest was paid semi-annually. It will be paid 10 times, so that would be 10. So this is basically the number of interest payments that would give us the bond discount amortization. So, for example, Candlestick Ink sold 100,000. This is the same example that we had before. Here we're using the straight line method. Okay, we have the interest that the company will be paying is always the same. This is always the same. This is the contractual interest rate multiplied by the face value multiplied by because it's semi-annual, by 6/12. Okay, this is always the same. So in this case, it is 10% multiplied by 100,000 multiplied by 6/12, which is 5,000. It's going to be always 5,000. This is regardless of premium or discount or amortization or etc. It's always going to be the same amount. Now the discount was 7,361. We have 10 payments, so we divide 7,361, we divide it by 10, and that would be $736. That would be the discount amortization every time. So this is the discount amortization. This is how we calculated it. if you remember, we said that discount amortization will increase the cost of borrowing money. So we add this one, we add them, and that would give us the interest expense that the company will be recorded. So although the company is paying $5,000 as interest, but the actual interest expense would have to also take into consideration the discount part for that payment. So the discount for the 10 payments for the 5 years is $7,361, but the company will have to recognize it with each payment. As a result, the company will be adding part of it, will be recognizing part of it, which is $736 with each payment. As a result, the interest expense here will be $5,736. Now the unamortized discount will be simply the original one minus, so that was the unamortized, this is the initial one, minus 736, and that would give us 6,625. And for the next year, for the next payment, it will again be minus this one, and that would be 5,889. On the other hand, the carrying value, it is always 100,000 minus this one, minus the unamortized discount. So it's 100,000 minus 7,361. It will be, so it is 100,000 minus this one. It gets us to this one. If it was minus this one, it will be 93,375, etc. And we can continue calculating this. So this is basically equal to 100,000. This is the face value minus this amount here, 6,625. And we keep doing that. As you can see here, we notice that the carrying value of the bond will increase until it eventually gets to 100,000. This is when the discount has been fully amortized. At that point, the carrying value will be equal to the face value at the end, and that will be at the end of the 5 years. On the other hand, the unamortized discount will be going down until it gets to 0. Once it gets to 0, it will be equal, we would have amortized all the discount and would have recognized all this discount and would have included it in the interest expenses. So Candlestick Inc. sold $100,000 5-year 10% bonds on January 1st, 2014 for $92,000, etc. The bond discount amortization for each period is $736. The journal entry on July 1st to record the interest payment and amortization of discount will be as follows. So this is the first payment. It will be, the company will be paying cash the full amount. The company will be paying cash $5,000. That will not change. The company's interest expense, so those are the 3 columns. Those 3 columns are the ones that are important for the journal entry. This is the interest expense, and the 2 components of the interest expense will be interest paid. This is the actual amount that was paid, as well as the discount amortization. So in this case, the company will be debiting interest expense $5,736, which is equal to 5,000 actual payment plus the bond amortization, and the company will credit discount on bonds payable $736 and will credit cash $5,000 because this is the amount that was actually paid. This is the actual payment. When we talk about amortizing bonds premium, now this is the same concept but the other way around. Here the premium will be decreasing the cost of borrowing. As a result, it will be subtracted. So it will be this one minus This one, it will give us the interest expense. Remember, regardless of whether the company sold the bond at premium, at par, or at a discount, the payment itself will always be the same. This is again the same thing. It is 100,000 multiplied by 10% multiplied by 6/12. It does not depend on those whether it was sold at premium, etc. It is at face value. Now the premium, this premium here, again the straight line method, we will divide it by 10 payments. That would give us 811, and this will be the same because it's the straight line method. It's going to be the same with every payment. So as a result, once again here, the interest expense is going to be once again the same for every time, for every payment. What will be changing will be the unamortized premium and the carrying value. Here the carrying value is 100,000. We add to it the unamortized premium. Remember, because this one will decrease the value. This one is added to the carrying value. The carrying value is the face value plus the discount plus the premium. Once again, originally the company would record it, and would record unamortized premium before they start recognizing it and amortizing it, and this one will be minus the amortization. That would give us the first payment, and then we have this one minus amortization. It would give us the second amount of the unamortized premium. The carrying value will always be 100,000 plus this one. It will be this one. Second one, it will be plus 7,300. It will be 107,300, etc. It's always going to be the same. And as you can see here, the carrying value of the bond will keep decreasing until it eventually gets to 100. This is when the premium has been fully amortized, and here also it will keep going down until it is fully amortized. Once it is fully amortized, it will be it has been basically fully recognized, and at that point the carrying value will be the same, will be 100,000. So let's see how this is done. Candlestick Inc. sold 100,000, etc. The bond premium amortization for each period is 811. The journal entry on July 1st to record the interest payment will be, once again, those are the three that we need to write the journal entry. The interest expense that is to be recognized is 4,189, and the two components are 5,000 and 811. So the company will be debiting interest expense. The company will debit interest expense 4,189. This is the interest expense. The company will also debit premium on bonds payable 811. The cash payment will always be credited. The cash will always be credited 5,000, and that would be the total amount of what that would be depending on the face value. So this is depending on the face value. This one is equal to 5,000 minus 811, and that would be basically the face value minus the unamortized, minus the discount, the premium amortization. So this is face value minus premium amortization. With that, we have concluded our chapter. We have talked about current liabilities as well as long-term liabilities, including bonds, issuing bonds at premium, at discount, at par, and redeeming them, as well as notes payable. And we also talked about amortization of bond discounts and bond premiums using the straight line method.